Welcome, ladies and gentlemen, from me, Guy Monson, to our regular weekly strategy update. It's been another strong week for equity markets. The Dow Jones up by almost 4%, other indices up by between 2 and 3%. The UK 5-year gilt dipped negative. That's a negative 7 basis point yield, extraordinary. And finally, the euro continued its upward ascent as European leaders meet in Brussels, face to face for the first time in 5 months, to discuss the remarkable recovery fund and the possibility for 500 billion euros in grants. What I want to talk about this week is a most unusual recovery, to look at these trends and see how this rebound that we've seen in markets and economies since mid-April differs from previous crises. And I'm going to try and do it in just 6 charts. Chart 1, uncertainty. There is still an extraordinary range of outcomes for global GDP this year, as Kristalina Georgieva, the IMF director, elegantly showed in a podcast earlier this week. She showed on light blue the projections for growth back pre-crisis, October 2019. In yellow, the projections post the COVID crisis, the sharp downward trend towards growth. And then she took her best case upside in green, which would primarily be a vaccine or medical solution discovered earlier than expected, and her downside in red, which would probably be a second spike and a resurgence of the virus into the winter. The difference between the two of them, an extraordinary 7 percentage points, the widest range that I've seen in my forecasting time here at Saracen. Issue 2, debt. As the IMF collates the numbers, it looks as though we're going to come out of this crisis with already 100% debt to GDP ratios for the average developed world government, and that probably rising up above 120% by the year end or into 2021. These will be the highest debt levels ever seen, higher even than the peak of wartime, and that's both in the developed world and the developing world. Now that provides challenges, but it also provides opportunity, a huge injection of fiscal spending, infrastructure products, green agenda products, as well as simple business support. We'll need to factor this into our thinking. 3, the US economy is recovering, but in a very different way coming out of previous crises. Retail sales, extraordinarily, are up above the level that they were pre-crisis. The figures were reported this week, up 7.5%, and at 477 billion, they're substantially higher than they were pre-COVID crisis. This is extraordinary. Mainly car sales and home improvements, among other areas that people are spending big in. Similarly, in the house building area, the highly respected National Association of House Builders, showing their key index again bouncing sharply and rising above pre-crisis levels, fueled, if you like, by ultra-low mortgage rates, record low mortgage rates. By contrast, 4, the labour market is still very fragile. Another bad week for US initial jobless claims, yes, lower than the previous months, but still 1.3 million, and continuing claims at 17.3 million. And I think there will be permanent scarring in the employment markets through bankruptcies, through businesses that won't restart, through capital investment that won't be deployed. So a very divided underlying economy. Issue 5, the dollar. Unlike previous crises where the dollar tends to rise, sucking money into the US and creating a funding crisis in the emerging worlds, this time round we've seen the reverse. As you can see on the left, the dollar index has actually moved lower for the year to date. The Federal Reserve was commenting just this week how few now of its lines for emergency dollar borrowing have actually been drawn on. This has helped power an extraordinary rally in commodities. We see copper, which we normally associate with sharp falls in an economic downturn of this magnitude, actually rising year on year, ending at a level higher than it was pre the COVID crisis. Finally, European assets are outperforming. This is normally a fragile area in a downturn. This time we've seen it one of the fastest to recover. Now just take the euro. I've plotted the index from the beginning of the year, but I've also shown a dotted red line, which marks the day when Angela Merkel and President Macron announced their EU Recovery Fund proposals. They did this on the 15th of May, and you can see the sharp rise up in the euro. I've done the same on the right-hand chart for equity indices from that 15th of May date. I've zeroed everything at 100. MSCI Europe up almost 27%, That's 10% ahead of NASDAQ. Europe, the really red-hot market for the last 8 to 10 weeks, again driven by this change in European sentiment, strong COVID response, a bold ECB, and of course the EU Recovery Fund. So what does this mean for our policy? One, prepare for uncertainty. And if there is uncertainty, it means central banks are going to continue buying bonds and hold those bond yields down. So we're taking advantage of that to switch from low-yielding gilts, in some cases negative, as I mentioned earlier, into higher-yielding but still high-quality corporate debt. Two, be prepared for an unequal response in the economy. That means rely on your thematic underpinnings to make sure there is recurring growth in the equities you hold, and you're not suddenly caught out by the second round effects of this crisis. Three, government spending is going to be big. So keep exposure to the green agenda, to renewables, and to infrastructure in particular, which for us are a powerful and high-yielding alternative to bonds. So that's just some of our thinking and how we're trying to blend in this extraordinary crisis and compared to many that we've seen in the past. Thank you.